The real battle this week was really between the Reserve Bank, which this week abandoned its hope of being able to keep rates on three-year bonds close to zero, and the markets. It also raised its expectations for the economy and inflation, but Governor Philip Lowe reiterated that he does not want to move interest rates for the next 12 months, at least.
It is possible that faster than expected progress continues to be made towards achieving the inflation target. The recovery of the economy and the recent inflation data have increased the probability of this. If this faster progress were to be sustained, there would be a case to lift the cash rate before 2024.
But Philip Lowe's efforts were thwarted slightly by the US Federal Reserve, which tapered its bond buying or money printing by $15 billion a month, with a view to cease it completely by the middle of next year as inflation rises in its economy. Here's Fed Chairman Jerome Powell explaining the strategy.
If the economy evolves broadly as expected, we judge that similar reductions in the pace of net asset purchases will likely be appropriate each month, implying that increases in our securities holdings would cease by the middle of next year. That said, we are prepared to adjust the pace of purchases if warranted by changes in the economic outlook.
Joining me now, Adam Creighton, Sky News contributor and also the Washington correspondent for the Australian newspaper. Adam, as always, thanks for your time. This has been the key issue this week, rising prices around the world, central banks clearly giving their response, trying to get back to some form of normal. And yet all of those central banks have got to be very conscious of not going too hard, too fast, for the fear that they really could tip the economies and indeed the markets over the edge of a cliff.
Well, certainly that's right, Ross. Indeed, we saw this week with the Bank of England, in fact, there was so much expectation that they'd be one of the first major central banks to lift rates. And of course they didn't. They held back because, they're worried, like all central banks, that if they hike too soon, that they'll completely crash their economies. And so central banks rather, in this huge bind globally, whether it's the Fed or the RBA or the Bank of England, where you certainly have these short to medium term, fairly sizable, significant inflationary pressures. I mean, in the US, the inflation rate is more than double the target of 2%. It's about 5.4%, and it's been that way now for many months. The same in the UK, it's about 4%. Of course, Australia too now is up to 4%. But there's a huge reluctance to lift rates too soon. And so there's a lot of confusion in financial markets right now, in the financial press. People don't really know what central banks are planning to do.
OK, so then go back to the core issue, which is inflation. And of course, it's always said a little inflation is a good thing, too much is a bad thing. There's been really no inflation almost for 2 or 3 decades around the world. And now central banks have to readjust. That's the key, isn't it?
Yeah, look, that's right. The interesting thing about inflation is certainly there are significant short-term pressures. That's obvious in the data, and probably medium-term too. But at the long end of the yield curve in the US, in Australia, and the UK suggests that investors don't fear a permanent breakout in inflation. Those interest rates, even for Austria's 100-year bond, are still extremely low, and so that suggests that the people investing in those bonds don't think that there is going to be a breakout. So if there is inflation, to the extent the market's right, and of course sometimes it's wrong, but I prefer to look at the market rather than the words of central bankers. I think the market generally gets it right more than central banks do. That the inflation will be transitory, if you like, although not as transitory as central banks would like. The Fed now is saying it's going to be above 4 or 5% for the next 6 months at least.
But one interesting part about this is companies themselves, and that is that they now start to be prepared to pass on price increases. And it doesn't matter whether it's computer chips causing shortages, whether it's actually supply chains themselves pushing up prices and shortages of goods. Some of these things may be transitory, some are a bit more sticky. But of course, companies in the past have had very little opportunity to raise prices. And that's the reason why markets actually might think that a bit of inflation is actually going to be quite a desirable thing.
Yeah, certainly that's right. The first big price increases were in the energy sector, obviously, and as you say, those price increases are rippling throughout the economy. Big fear for central banks, of course, is that inflation expectations lift up and then everyone starts lifting their prices, whether it's wages or goods and services, and that, of course, creates a self-fulfilling prophecy. I mean, it's not true that that's set in yet, but certainly it could. One of the interesting things I think about this post-COVID economy is many of the small and medium-sized businesses that once competed with larger businesses, they've gone broke. And so your big monopolies throughout the economy have much more opportunity to lift prices than they did 1 or 2 years ago, and I think you're going to see that much more. It's going to be harder for governments to ensure that their major markets are competitive now.
Adam, thank you so much for your time today.
Ross, thanks so much.